Since you clicked on this video, you must have had questions about bonds. Do you know what bonds are? How does the bond market work? And is bond investment a good option? Hello 101 community, welcome back to our YouTube channel. In this video, we'll explain everything you need to know about bonds. But before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Now let's start. What are bonds? In exchange for regular interest payments, a bondholder loans money to a business or the government for a predetermined time. When the terms are met, the bond's issuer pays the investor their money back. Since your investment will generate fixed payments for the bond duration, the term fixed income is frequently used to characterize bonds. Businesses issue bonds to fund existing operations, brand new initiatives, or acquisitions. Governments sell bonds to raise money and complement their tax collection. When you invest in one, you become a debt holder for the organization issuing the bond. Bonds are a crucial part of a well-rounded financial portfolio, since they often carry lesser risk than equities, especially investment-grade bonds. Are bonds a good investment? Many financial gurus agree that bonds may be a terrific addition to your investment portfolio when used wisely, along with equities and other assets. In contrast to stocks, which are bought as ownership shares in a corporation, bonds are bought as debt obligation of a company or public organization. The larger your stock concentration, the more time you have to weather market swings. Stocks pay higher interest rates but also entail greater risk. You'll want more bonds in your portfolio as you go closer to retirement because you'll have less time to weather financial turbulence that could deplete your savings. Bonds might make up 10% of your portfolio in your 20s. By age 65, that number is probably closer to 40% or 50%. The potential for tax advantages, which are only available with specific types of bonds, such as municipal bonds, is another distinction between stocks and bonds. In addition, bonds still entail risk, such as the likelihood that the borrower would declare bankruptcy before repaying the debt, despite being far safer investments than stocks. Types of bonds. There are a virtually infinite number of different bond types. Depending on the organization that produces them, investment-grade bonds in the U.S. can be broadly divided into 4 types: corporate, government, agency, and municipal. Different tax treatment is another property of these 4 bond classes, which is an important factor for bond investors. Corporate bonds. Both public and private businesses issue corporate bonds to raise money for ongoing operations, increase production, funding for research, and acquisitions. Federal and state income taxes apply to corporate bonds. Government bonds. The federal government is issuing U.S. government bonds. Because the United States issues them, they are frequently referred to as treasuries. Treasury Division. The proceeds from selling treasuries fund every part of government operation. Federal taxation is due, but state and municipal taxes are not. Agency bonds. Government-sponsored enterprises, GSEs, like Fannie Mae and Freddie Mac, are issued agency bonds to pay for federal agriculture, education, and mortgage lending programs. Some of the bonds are free from state and municipal taxes, but most are subject to federal tax. Municipal bonds. States, cities, and counties issue municipal bonds to finance regional initiatives. Municipal bonds are an attractive investment for high net worth investors and those looking for tax-free income during retirement because interest collected on them is tax-free at the federal and state levels. If you like the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. So let's continue. Advantages of investing in bonds. Bonds generate income. Although many assets yield income, bonds typically give the highest and most consistent cash flows. There are many options available for you to employ to create a portfolio that satisfies your income demands, even when interest rates are low. High-yield bonds and debt from emerging markets could be used in these strategies. Above all, a solid bond portfolio may offer respectable yields with less volatility than equities. Additionally, they have a higher potential for profit than bank assets or money market funds. All of this suggests that bonds are an excellent investment for people who depend on their investment income for their living. Bonds provide diversity. The saying, "Don't put all your eggs in one basket," is one that almost everyone has heard. Although it may be overused, this knowledge has lasted the test of time. Over time, a more diversified portfolio may offer better risk-adjusted returns than a portfolio with fewer assets. In other words, it decreases the return on risk. Bonds can, more crucially, assist equities investors in protecting their cash while the stock market is declining. Bonds maintain the principal. For those getting close to the time when they need to utilize the money they've invested, fixed income investments are quite helpful. This might be the case for someone who's 5 years away from retirement, or a parent whose child is enrolled in college. As a result, as you get closer to your goals, it can be a good idea to increase your fixed income allocation and lower your equity allocation. Bonds provide tax benefits. Bonds of a particular sort can be advantageous for people who need to lower their tax obligations. While interest on municipal bonds is tax-free on the federal level, income from bank instruments, the majority of money market funds, and stocks are taxable unless the assets are held in a tax-deferred account. It is also tax-free at the state level if you own a municipal bond issued by the state in which you currently reside. Revenue from the U.S. state and local taxes does not apply to Treasury securities. Tax considerations shouldn't be the primary factor in your investment decision, especially if you're in a lower tax bracket. However, the fixed income world offers a lot of methods that might decrease your tax burden. Stocks versus bonds. It's critical to remember that stocks and bonds are financial tools in your wealth building or maintenance toolbox. Just like cash, real estate assets, precious metals, cryptocurrencies, and a long list of others. Through asset allocation, it's crucial to use the right instrument for the work at hand. What is known about stocks and bonds as instruments for investing? While stocks typically outperform bonds over the long term, bonds are more stable in the short term. The opposite is true for equities, which can be extremely volatile during economic unpredictability, but have historically produced superior returns on investment when held for 5 years, 10 years, or even longer. That's especially true if you frequently make investments and new financial contributions. As a general rule, you should own more stocks and fewer bonds the further away from a financial goal you are. However, you should invest more of your assets in bonds as you get closer to that goal, such as retirement, paying for a child's education, etc. The goal is to use bonds to safeguard your capital while maximizing the long-term wealth-building potential of equities. Interest rate effect on bond prices. When interest rates rise, bond prices often decline. In contrast, bond prices rise when interest rates fall. At first look, this inverse relationship could appear a little difficult to understand, but a chart can help. Bonds, as opposed to stocks, are a loan given by an investor. Often, the loan is to a firm or government entity. In exchange, the investor receives fixed-rate interest income, often semi-annually, which remains constant regardless of potential changes in market interest rates. Bonds compete with each other for interest, depending on their time to maturity and the interest rates. New bonds yield higher yields, increasing income as rates go up. New bonds have a lower interest rate and are less alluring when rates are lower. The bad news for bondholders is that when interest rates rise, fixed-rate bond issuers cannot raise their rates to match those of newly issued bonds. Based on the original conditions, the rates for the older bonds are fixed. Thus, lowering the bond price is the only option to boost competition and draw in new investors. The price of the asset owned by the original bondholder has plummeted. Additionally, it doesn't pay out as much as comparable recently issued bonds. Bonds are crucial in your investment portfolio. You'll have to research which bond is suitable for your needs and how long it would take for the bond to mature. With good research, you'll hopefully find a good option, and it'll help you make more money. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you'll be notified of every update. Also, don't forget to check the links in the video description. And while you're here, I'm sure you want to continue on the path of financial education. Click to watch the video appearing on your screen right now. I'll see you there. Take care and stay tuned.